Hi, I'm Patrick Mather, the founder of SpendLogic. Welcome to another live stream event here on YouTube. We'll just get going here. We're going to talk about weighted guidelines profit analysis. This is something that we're asked about quite often, actually, especially in our cost analysis engagements when we have access to a lot of data. And I know that many people out there are using the weighted guidelines, but they don't fully understand what's going on. So today, I'm not going to give you your PhD in the weighted guidelines or in profit analysis, but what I am going to do is I'm going to show you the basics of how the weighted guidelines works, and I'm going to introduce you to a free tool that we have online, which is basically a simplified weighted guidelines, which you can use anytime. It's out on our website, it's public, it's available. And we've just adapted DoD's weighted guidelines to a more user-friendly graphical user interface. So what we're going to talk about here today, we're going to talk about the basics of profit analysis. What is a weighted guidelines analysis? What are some of the limitations in FAR? How does SpendLogic handle it? And then I'm going to go through each of the areas of calculation that you're going to be looking at. Again, we're not going to go in super deep detail, but it's probably going to be more than you're used to or more than you've seen in the past, unless you've deconstructed the weighted guidelines like we have. So anyways, let's get started. If you have any questions, just like always, send it over to us in the chat box. But if that doesn't work for you, some people have a hard time logging in, you can always reach us at info@spendlogic.com and we will get back to you as quickly as possible. All right, without further ado. So the first place to start, if you want to learn about the weighted guidelines and really just profit analysis in general, since you're all in government contracting, go to the FAR. If you go to FAR 15.404-4, that's a great place to start. And here's my very high level paraphrasing of what is said there, okay? So first of all, it notes that profit is there as a motivator of efficient and effective contract performance. A lot of times, we've all been in a situation where we get down to the end of negotiations and we're just kind of trading profit back and forth. That's really not the intent. The contracting officers, and I'm going to speak from a contracting officer to a contractor, but this could be the contractor to subcontractor. The idea here is motivation, and that if you get profit down low enough, then it's no longer motivating, and in the long run, it hurts everybody in the ecosystem. Next, in the FAR, it notes that a structured approach is encouraged. Okay, there are many structured approaches out there, and what I'm going to focus on is the weighted guidelines, which happens to be the DoD's structured approach. Other agencies can use this same approach. There's also something in there that says that you can use other agency approaches. So this may apply to you even if you're not DoD. Next, something to note, we hear about limits. Oh, we can't charge that much fee, or we can't ask for that, or we can't award that. That's higher than FAR will allow. I mean, in some cases, yes. There are 3 specific cases where FAR says you can't go beyond these limitations on profit, but they're very limited. They're all cost plus or cost reimbursable type contracts. 10%, 15% for experimental, which is a pretty high fee. Architect engineer is capped at 6%, and then other cost plus is 6%. Or I'm sorry, 10%. If you've got a firm fixed price contract and you want to propose 25% fee, you're absolutely welcome to do it. Is the government going to agree to that? And that's a whole other conversation, but there is not a statutory limit in the FAR for that. They just have to make sure that it's reasonable, and that's where analysis comes in. And last but not least, for those of you that are contractors, non-government, the contracting officer, it notes in FAR, shall not, means cannot, ask for the details of your profit analysis. You can give it to them, but as a basic rule of thumb in negotiations, you should hold that back, because that just opens Pandora's box. Fee is what it is, and you go from there. Okay. Next, I want to talk about, how does this all fit together, So further into the FAR, if you continue reading that section, it states that there are required profit analysis factors. So these are the things that the contracting officer, the agency, has to take into account. Again, the FAR is written for the government. It is not written for contractors. There are there are legal requirements within the FAR, but not everything is required. So if you don't use the weighted guidelines, then so be it. But this is what the contracting officer is going to be using. And they have to take into consideration, any independent development, cost control efforts, your contractor's effort, contract cost risk, any socioeconomic programs, and your capital investment. And all of those are going to be used to balance profit. If you have large impacts from any of those, then you're going to have to require a larger profit. I note this because this is how you negotiate profit. This is how you talk in a manner that the contracting officer is going to hear. And as we get into the details of the weighted guidelines analysis, this will give you other talking points. But recall this, as you get into those negotiations with a contracting officer or a prime or a sub, if you speak in terms of these categories, then you're going to get further along and you can have more of a fact-based negotiation on something that is a lot of times largely subjective. So now let's get into the actual weighted guidelines itself. So what is the weighted guidelines? Well, I just mentioned that FAR notes that they should have a structured approach. The weighted guidelines is the DoD's response to that recommendation of a structured approach. Okay, so you could go, and again, we're talking DoD. I just want to make that clear. You go to the DFARS, go to 215.404-71, and you can get all of the messy details. You can build your own weighted guidelines if you'd like. All the data is there. It is not simple to do, but it is there if you dig far enough into it. So the weighted guidelines itself, and I'm going to show you the DoD's form here in just a second, but high level, it's split into sections. And these are the areas that the DoD looks at and then adds together so that they come up with your composite risk or your composite profit, I should say fee percent. First, performance risk, and again, we're going to get into each and every one of these separately, so I'm just going to walk through them. Performance risk, contract type risk, and working capital adjustment, facilities capital employed, and then cost efficiency factors. So we're going to go into each of those in detail, but before we do that, I want to show you, for those of you that have been in contracting here for a while, you may recognize this form on the right. This is something that we actually built internally, but it looks very, very similar to the 1547 that the DoD uses. There's a few subtle differences that a trained eye would recognize. But for the most part, on the left-hand side, you see the performance risk, contract risk, all of the things that the weighted guidelines takes into account, and you can see exactly where each of these occurs on this form. So, if you just looked at this form, you wouldn't be able to understand it. Probably, if you have a trained eye, then you could. But what we talk about here from this point forward is really, it's the same thing that you're going to be doing if you were to fill out this form, but we're going to be doing it in the SpendLogic format because it's easier and because it has a little bit more information and more explanation as to what should be included. So the first area that we're going to talk about is performance risk. Okay, so what is performance risk? This is the risk of fulfilling requirements or of not fulfilling requirements, right? And performance risk, as far as weighted guidelines is concerned, is broken into two categories: cost control risk and technical risk. So if performance risk is 100% and you've got two categories, then you need to weight each of these, okay? And that's the first thing that you have to do. So cost control risk is your management control that's necessary. So this is your cost control type stuff versus your technical risk, which is technical uncertainty. So if you've got something really, really complex that you're doing, then you're going to have a higher technical risk and a lower cost management risk. If it's something that you're repeating that has little or no technical risk, then you're going to have a very high cost control risk as a percent of total and a low technical risk. They play off of each other. So first, you're going to assign a weight to each of them. You're going to then assign a score, and then you're going to calculate the composite. So if each of them is 50% and you assign a score of 5% to each, then you're going to come out with a composite score of 5%. Okay. Let me show you what this actually looks like in SpendLogic. So again, this is our weighted guidelines tool, and you could get to it on our website. You go to spendlogic.com. If you click resources, links, and tools, then you can scroll down and get to the weighted guidelines, the profit calculator. So once you go there, you can see that you get into the different areas that we're going to talk about. So I'm going to be jumping back and forth between PowerPoint and our tool just to show you how we do it. Again, you can use the DoD form if you're knowledgeable, or you can use your internal forms. All of this is going to translate because it's all taken directly from the DFARS. So the first thing that you see here in our tool is the split between management and technical. Okay, it's a slider, makes it a little easier, and it makes it so that you can't assign anything other than a total weight of 100%. This 43% goes to technical, so the rest goes to management. Okay. The next thing that I noted that you're going to have to do is you're going to have to assign a score. Okay, so the median score, or the normal score here, is 5%, and I think the range is 4 to 6%. Okay, this is, again, look at the way the DFARS if you want to see the details of this. But the DFARS also notes that there are ways that you can support going above or below normal. So what we've done in our tool is we've just said, okay, you can choose the normal risk. We've got radio buttons. Go ahead and choose the normal risk, okay? Or if you meet the requirements of above normal, you can read the requirements and choose above normal. And what that does is that automatically at the bottom weighs into calculated profit. Okay, so it'll automatically assign what that above normal category, if it's a 6% score in the DFARS, it'll automatically assign that. Okay, so you see that for technical risk, and then a rationale box. Then you see it for management and cost risk and a rationale box. So an important point that I want to make here, and it's noted in the tool itself, it says provide an explanation if anything other than normal was chosen. So this is going to be, if you're in negotiations with your contracting officer, and if you start going down the path of weighted guidelines, this is one of the things that you're going to have to include. Additionally, if you write a cost analysis and you do a weighted guidelines profit analysis on your subcontractors, what you should be including is your rationale for anything other than that normal category. So if you're either above normal, significantly above normal, below normal, significantly below normal, then these are things that you should be talking about. Okay. Last point on this performance risk. In technology, okay, there are actually, in addition to above, significantly above categories of technical risk, you also have special technology incentives, and this goes above and beyond normal, okay? You can see explanations as to what's included in each of these, but really this is for the really, really detailed, very highly complex technical efforts. And this has quite an impact on your profit rate. So if you do have, something that fits this category, then you want to make sure to include that, not just using the typical above normal or significantly above. Go that extra step and go special incentive. That's performance risk. That's the first section in the weighted guidelines. The next one is contract type risk. Okay, so what's contract type risk? This is the risk based on the contract type. So, your risk as a contractor is going to be higher or lower based on the flavor of contract that you have. And you can see this in the little graphic that I've got here on the screen. If you've got a time and material type contract, you're basically being paid your time and your material. So if you incur bills, then you're going to get paid. There is very little risk in that scenario. Now, I know there are situations where a T&M may be more risky, but by and large, that is the least risky type of contract that you can have. This goes all the way up to a firm fixed price, okay, with no progress and no performance-based payments. And again, this is a base. This is only part of the calculation, okay? Contract type risk. This is going to be added to the other parts. So when I show you here that FFP has a 5% risk factor, that doesn't mean that FFP contracts get 5%. It's just that based on FFP, you get an extra 5% in the calculation of weighted guidelines, okay? What you see here, these are the normal categories. There are lots of flavors. In fact, let me show you the flavors that are mentioned in the DFARS. So if I flip over to the SpendLogic tool, I get into the management and cost risk. Okay. Oops, I'm sorry. Not management and cost risk, contract risk. And there are lots of different flavors. In SpendLogic, you just choose the flavor of contract and it automatically assigns the weight that it should have. These are, again, taken out of the DFARS. We've tried to simplify it for you so that you can just choose it and not worry about whatever number is included in the background. Next, it's mentioned that you have a working capital adjustment. Okay, this only applies to fixed price contracts that have progress payments. Performance-based payments, it does not apply to, okay? The very basic idea here is that if you have progress payments, there's going to be a holdback, okay, until that final payment, you know, as far as the passage of time goes. And it's, I don't know, typically 20%. I'm just going to throw that out there. So that 20% is a working capital amount of money that they have to use, the contractor has to do without in running their business. So, you know, a very basic way of looking at this is that it's kind of like being paid interest on that money. And I don't suggest that you say that in negotiations by any means, but I'm trying to paraphrase it and put it in a very simple term. The way that this works in practice in SpendLogic, it asks you, okay, do you have progress payments? If you have firm fixed price with progress payments specified, then you note the contract duration and the percent that you financed. And by percent financed, that means what's the holdback? As a business, you're really financing that for a period of time, contract duration. You know, so if it's 20%, then, you know, what is that going to mean to, you know, your working capital and the funds available to run the business? It's not used a whole lot, but it is part of the weighted guidelines analysis, so I wanted to bring it up. Another factor is facilities capital employed. This is used even less frequently. And really, the only time you're going to get into facilities capital employed is if you have access to their full books of record. And this is going to happen in an analysis of certified cost of pricing data or a FAR compliant cost analysis. So it's over the $2 million. It's not been competed. It's not a commercial item. You know, it passes all those tests, and you got to do a cost analysis. Then you may have this data. In the 20 years that I've been doing this, it has been used very, very little by us, but it's there in case we do have that data. The basic idea is that what it's doing is it's rewarding investments that benefit the agency. So it benefits the DoD if you invest in new facilities capital, equipment. So if you do outlay that money, then they're going to say, hey, we appreciate it. Thanks. Here's a little extra profit to help you, you know, make the business case to actually do this. Again, you really have to get into the balance sheet to do an assessment. And the impact of this is a very, very minimal percent of profit or as a percent of cost. We do handle this on the spreadsheet or on the SpendLogic tool here, but it requires you knowing what your facilities capital cost of money is and how that splits out. We have a separate calculator that just goes into that, and it gets into net book values and a lot of accounting terms and stuff like that. So for the most part, you're not going to be using that on a regular basis, but it is there in case you want it. Next, this one's a pretty heavy hitter, the cost efficiency factor. So what this is special consideration for any cost improvement initiatives. And it's, you know, in my time as a cost analyst and doing negotiations with suppliers, this is something that they hit on really hard. Any opportunity they could to show, you know, we're saving you money, Mr. Prime. We're saving you money. Therefore, we should get some sort of kickback. I guess I can't say kickback. We should get some sort of compensation for investing our time and energy in these cost improvement initiatives. So this is a really interesting area because your contracting officer has what's called maximum flexibility. They can make it do whatever they want to do. This is good and this is bad. It's great because if you make a good case for it, then the contracting officer has the ability and the flexibility to go ahead and assign that cost efficiency factor. It's bad because it can be highly subjective. Basically what you have to be able to show, and what the contracting officer is going to need to be able to show, is that the cost improvement initiatives that you're taking on benefit this specific procurement that they have in play. Not something that you did 10 years ago that, okay, trickles in, but something that you're doing today that is going to have an immediate benefit. Then, it's up to 4%, right? So how do you argue for 2% versus 4%? You're going to be best off if you can show the business case that shows exactly how much you're actually going to save them. So if you're going to save them, 10% overall, then you have a really good case to make for the full 4%. Okay. Otherwise, if it's something lower than that, then they're going to ask for a split, and it's all a point of negotiation at that point. Okay. If you look at the SpendLogic tool, this is handled down here in the cost efficiency factor. It's a simple slider. So what's interesting about this is as you slide it up, okay, you're going to have an immediate impact on your total profit. This is a direct one-for-one. And that's why it's something that, can be very, very useful, obviously. Last but not least, it requires an explanation. Okay, we put this box here so that when you print out this report, you have all of the data that you need and all the feedback that you need, to make sure that you can support your case. But again, if you're doing this with a prime or with a contracting officer, they're going to really be looking for that business case and see, okay, well, where did the 4% come from? They don't just hand out 4% because they feel like it that day or whatever. But they do have the ability to do that, the flexibility. They just don't. Okay? So again, and then last but not least, if you fill this out in SpendLogic, you can provide your email, and it'll email you a copy of this, weighted guidelines analysis. If you're a subscriber to SpendLogic, then you can then import that as your profit rate, especially if you're doing like a services analysis or something like that. So very, very basic recap here. Go ahead and check out FAR 15.404-4 and DFARS 215.404-71 for information. All of this that I've shown you here today is in the FAR and in the DFARS. There's no magic to it, other than the fact that it is a little complex on the back end and gets a little bit tricky. Also, I'll note that if you prefer to use the DoD's tool, you have every ability to do that. They provide it for free. It's out there. You just have to download it and then learn how to use it. Ours is a little simpler, but it'll get you to the same spot. Note also next that there are very few limits on profit. So if somebody tells you we can't propose that or we can't accept that because of the FAR or the DFARS, that only applies in cost plus, cost reimbursable type contracts, and only in 3 specific cases. So there you go. There is, by and large, there are not limitations on profit. However, it still has to make sense, from a price analysis and a cost analysis standpoint. Next, your contracting officers, remember, they cannot require your weighted guidelines, and I'll stand here right now and recommend that you do not provide the weighted guidelines analysis. Every single item on that list can be, even though it may be an objective call as above normal, below normal, whatever, once you get into the details, the deeper you dig, the more subjective you can get. So it is not recommended that you provide the weighted guidelines, the details when you're in negotiations. Having said that, from the other side of the table, it's always recommended that you ask for it from the other side, because again, you can nitpick anything that you want and get as deep as you want. So always ask for it, never provide it. Last, explain any scores that use anything other than normal criteria. So if you're going to be providing a weighted guidelines analysis in any format, even if it's internal compliance or internal management reviews, be sure to use that, your explanations for anything that's above or below normal. That's really going to be key to understanding whether you have assigned your weightings correctly, your scores correctly, and whether it really makes sense. If you can't make the story as far as why it should be above or below normal, then normal's probably where you ought to be. Last but not least, thanks for watching. We really appreciate everybody participating in these sessions. We get a lot of great emails afterwards and folks that reach out to us and let us know that this is useful or this is not useful. We've actually heard that folks are using this for internal training purposes, which is fantastic. We're happy to support. We provide training, we provide cost analysis services, and obviously we provide software through SpendLogic. So if you have questions or need help in any of those areas, please reach out to us. You can learn more at SpendLogic.com, or you can reach out to us at info@SpendLogic.com. Subscribe to our videos and we will let you know when the next one's coming up. Thanks again, and we will see you again soon.